Good morning, everyone. Thank you for joining us today on a Saturday morning, and that too on a long weekend, right? So it's so on today's webinar, right? We have Prescient Capital, who is going to be talking about how it is a good time to be investing in the Indian markets at the current context. Just to give you a brief on Prescient Capital, or rather, what they do as a investment firm, right? See, there are multiple types of investing. Investing is not a one size fits all kind of game, right? For each type of a person, each type of investing works, and the type of investing that works for Prescient Capital and has worked for Prescient Capital for a very long time is what they practically call the private equity style due diligence type of investing, right? So, with us, we have Mr. Sonal and Mr. Anubhav, who have a combined experience of more than 15 years of market experience, right? Specifically into private equity, where they look at investing into a deeper lens. So, with any specific idea or any specific thinking that they establish, they come with the practice of looking at things very deeply and analyzing things very deeply before they get onto the client's portfolios. So today we have Mr. Sonal and Anubhav, who will go on with the presentation, and I welcome you both to Beyond MF and FPS Assets to start off the presentation today. Thank you, Sonal. Please go. Over to you.
Thanks, Ganesh. Thanks for the warm introduction. And thanks for the FPS team and the people who are here on the webinar for joining us over a weekend. So I'll start with a quick introduction. So Prescient Capital is a public market
Cool.
PMS, which is co-founded by Anubhav and myself, Sonal Minhas. Uh, we both carry we both carry a decade-long experience of having worked in top-tier private equity funds in India, where we were investing in public markets. So our cumulative experience individually of investing in public markets has been close to 15 years. Prescient Capital is structured as a PMS. As I said, it has an AUM of close to 430 odd CR, and we started the PMS roughly 5 years back. Can we change the slide? So we are basically a public market PMS. We have an AUM of close to 430 CR. Both Anubhav and I carry a decade-long experience of having worked in top-tier PE funds in India. Uh, our key differentiator, which is highlighted on this slide, and which has been actually quite instrumental in us delivering good returns over the last 5 years of setting up Prescient Capital, has been our private equity approach of investing in general in public markets. In specific, Anubhav, can you move to the next slide? Yeah.
Sure.
So in particular, I think there are three pillars of what we call the private equity form of investing in public markets are. Number one is that we are looking for a very high pedigree founder who has a stellar track record of governance and having dealt with minority shareholders in a reasonable manner. Number two, uh, we are actually looking for businesses which have a very strong growth tailwind ahead of them in front of them for the next 3 to 5 years. And number three, which is the discipline on the valuation of these companies, which is that we try to invest in these companies at the bottom quartile of valuation at which these companies trade at. Now, the private equity approach is a wrapper on top of this framework where we select around 25 odd companies and uh, put them through this rigorous framework of first identifying a good, honest, high pedigree founder, which means that we do deep qualitative and quantitative checks on the promoters. Uh, Roughly 50% of our time gets spent in selecting and weeding out founders based on this framework. We hold ourselves accountable on this KPI to a large extent. And so far, our success or accuracy in identifying good, honest, high pedigree founders has been more than 95%. So this is the first pillar of our private equity approach of investing, where that we do not need to go wrong on the founder, and we will spend inordinate amount of time to build our comfort on the founder. Once we build this comfort, we do our business diligence on the company. The way we differ a little based on our private equity framework is that we not only consider the public listed universe for companies, its industry, its peers, we also step back and look at the private universe of companies in this particular, for a particular company, a particular sector. And we also look at the international competition. The reason we do this particular bit is that we want to build a 3 to 5 year out outlook on the company and the sector in a way that first of all, we are not entering this company or a sector when it is hot or it is basically actively debated upon being as a hot sector. B, there should not be any disruptor which is coming from behind, which basically makes the sector unattractive, unviable over the next 3 5 years. And C, also try and look at competition from a public listed universe of set of companies which are getting listed in this space over the next 3 5 years. So this gives us the comfort that we are entering at a point in time where a company is available and there's also a scarcity value in terms of ownership of that particular company. The third bit, which is what I talked about, which is the valuation, I think we would be amongst the most conservative PMSs in terms of valuing businesses while we enter. We don't go for forward PE multiples. We don't go for any forward multiples, valuations, whatever exists. We try to enter businesses at their bottom 10, 30 percentile valuations. Sometimes for this, we have to, after having done our work, we have to wait out for a year or two to enter a particular company, but it doesn't matter. This is a very strict principle for us. And we've seen that almost 90% of the companies we have invested in, because of this rigorous discipline of valuing the businesses, entry multiples and our exit multiples, we've seen re-rating of 90% of the businesses that are there that are there in the portfolio. So this is a quick wrapper on top of the private equity framework that we've used so far over the last 15 years, over the last 5 years of Prescient Capital. We'll address more of this in the Q&A. Moving to the next slide, Anubhav. The next slide, yeah.
Uh,
Yeah, so this framework has actually helped us deliver stellar returns in the last 5 years of our existence on the whole, and in particular over the last 24 months, which have been very painful for the Indian markets. Everybody knows about that, but I think our returns stand out both in the longer term, but in particular over the last 12 to 24 months, which have been very difficult. We have outperformed the indices, both the BSE 500 TRI and the Nifty Small Cap Index, by a margin of 6 to 9% on an average. And this is a testament of our framework, as we will explain this more in greater detail. Anubhav, to the next slide. So our framework is specifically designed, our strategy is specifically designed to actually outperform during periods of drawdowns or periods where markets are seeing negative returns. We have captured that in the two charts that we've covered on this slide. I want to spend a little bit of time to explain this. Prescient Capital has been in existence for the last 18 months. In the last 18 months, we have seen 25 months of negative returns at Prescient Capital. We have seen 30 months of negative returns out of the 80 months for the small cap index. We have seen 29 months out of the 80 months of negative returns for BSE 500. So the point I want to make here are two. First of all, that we've seen lower number of months of negative returns compared to the broader two indices that I've just spoken about. That's one. And secondly, the two indices have a set of 500 and 250 respectively. For us, the portfolio size is 25. So despite managing a more concentrated portfolio, we have given fewer months of negative returns vis-a-vis the index, which has 250 to 500 companies, and the uh, hence the volatility or the variability of returns is far lesser. The third point I want to make here is that if you see BSE 500, BSE 500 has given roughly, as I said, 29 out of 80 months have given nine negative returns. Out of these 29 months, if we look at our funds data, in 70% of those 29 months, basically, we have given better returns than the BSE 500 index. What that essentially means is that, let's say, in a given month, if BSE 500 has corrected by 5%, we would have corrected by, let's say, less than 5%, which is 2 or 3%. So not only have we had fewer months or negative returns, in the months the index has corrected, in 70% of those months, we have corrected far lesser than the index. So between the last slide and this slide, we want to capture the point again that our framework is specifically designed to have less drawdown, to have less negative returns, which is actually a way in which a particular portfolio gets tested, typically over a 4 or 5 year period. Anubhav, moving to the next slide. So the end result of this framework and the end result of what we've done in the last 21 months has been that our portfolio has had an alpha of 10% over the underlying indices, which is Nifty 500, Nifty Small Cap, and Nifty Micro Cap. If we're to, I think, look at last 21 months, the last 21 months have been fairly brutal from a lot of from a geopolitical perspective and also from a perspective that the Indian capital markets have been hammered left, right, uh, or compared to other global markets as well. So delivering an alpha of 10% in this particular period over the underlying indices and is something which basically speaks lengths about our the way we do our diligence and the way we identify our companies. We will cover what helps us do this or deliver this alpha over the indices, over other maybe fund managers in greater detail. But I want to leave you with a simple point here that the way the process is designed for us is that people like us who are conservative, who follow a very deep methodical research, we are essentially identifying good, honest, very high on execution companies. And what we've seen typically over the last 15 years is that in bad times like the last 21 months, these companies basically tend to do better than the overall market because capital consolidates towards names which are safer, conservative, good on execution bets. People gravitate towards taking lesser risk and focus on businesses which have a proven track record, proven governance standard and not focus on hot names, hot ideas, hot sectors. And hence, people like us basically outshine and outdeliver during this particular period. Moving to the next slide, Anubhav. Yeah, so in this section, we want to capture why the last 21 months have been first bad for India and also then talk about what lies next in front of us. So, covering the first part in detail, last 21 months have been brutal for India. Some people, so when we compare India to, let's say, indices, countries like South Korea, Japan, US, China, Brazil, almost all the indices have outperformed India. India has been the worst performing market over the last 21 months. Some say this is because India does not have an AI play. Some say this is because India was expensive. We believe in the latter, which is that India was somewhat expensive, and the growth that we've seen in the Indian companies has not been commensurate with what the valuation they were at over the last 21 odd months. And hence, India has seen a both time and value correction over the last 21 months. the correction has been fairly brutal. If we were to basically consider this, we've analyzed a universe of 2,000 odd listed companies. And we can say that if you look at this particular slide in greater detail, you can see that despite reasonable or okay earnings growth, roughly 80% of the companies have actually delivered subpar returns out of the 2000 listed company universe in India, which means that one in five companies have given above par returns in the last 20 odd months. And hence, stock picking has been very difficult, and it has been very critical to identify the right companies with the greater detailed research and identify good founders. Then only you would, then only the chances that you would be above par in returns are there, and hence it has been fairly tough to even deliver that. So we want to capture the same data with a different analysis on indices. First thing I want to capture is that the earnings growth in India has happened over the last 24 months. If you see Nifty 500 EPS growth, roughly 16%, Nifty mid cap EPS growth has been 60%. If you look at Nifty micro cap, the earnings growth has been 7%. Despite that, if you look at the returns have been either in red or barely zero, basically, or thereabouts. This is largely because most of these indices were trading well above their long-term median 10-year average valuation levels back in September 24. And as a result of which, despite reasonable to medium earnings growth, uh, the uh, the valuations have corrected. There's been either a time correction or let's say a value correction in all of these basically indices as well. So again, capturing the same point with a different slice. Moving to the next section, Anubhav. In this slide as well, we want to capture again the same point that, but by sectors now, that again, in the last 21 months, what we've seen is that sectors that were expensive back in September 24 uh, and have grown medium to average in terms of their earnings. Almost all of those sectors have delivered negative returns during this particular period. Whereas on the flip side, sectors which were not expensive or sectors were the medium in their valuation range, basically, and have delivered average to above average earnings growth, have been the ones which basically um, uh, have delivered positive returns. So if you see the chart on the extreme right, the sectors like PSU banks, sectors like healthcare, sectors like metals were sectors basically which were at the bottom quartile of their valuation. So with medium to above average earnings, their returns have been positive. If you look at the index from a larger perspective, the sectors which represent the index by and large, IT, FMCG, private banks, uh, even auto, basically consumer durables, these add up to form a large part of the index. Almost all of them have delivered negative returns. So therefore, again, stock picking has been difficult, and focus on individual companies, focus on individual names has been the mantra to deliver above average or positive returns. I'll pause here and I'll pass the baton to my partner, Anubhav, who will now talk about how we see the markets from here on and how we are building our portfolio from here on. Back to you, Anubhav.
Thanks, Sonal. Hope I'm audible clearly. Well, I'm not audible.
Yes, you are audible, Anubhav.
Okay. Thanks, Sonal, and welcome everyone to this webinar, especially on a like weekend. So I'm Sonal's co-founder, and we together started Prescient Capital, like Sonal mentioned. So till now, Sonal has covered that. Like what is our strategy and how do we try to differentiate ourselves, and then he took us through how past almost 2 years have been difficult overall for the market. Returns have been scarce, a very narrow portion of the market has delivered good returns. So now I'll discuss why we feel at Prescient that overall the market structure is attractive to invest incremental capital or start investing at this point of time. And we have we'll cover two basic reasons for that. Firstly, there has been a long phase of consolidation or correction, whatever you want to call it, and there has been brutal correction in individual names. Valuations have come down. So from a starting valuation point of view, we are finding very good businesses run by very honest and competent promoters available at attractive valuation. And the second point we want to cover is, if you leave aside geopolitics, obviously from a geopolitical point of view, last 1.5 years have been like a nightmare. Starting from the US tariff, then this war broke out. Once the sort of US tariff got resolved in January, February this year, we all thought that Indian markets will now bounce back. But again, the Iran war broke out in late Feb, early March. There is no clear resolution. Hopefully, it will get resolved. There are talks of a like truce and agreement on all of that. But again, that cast a very negative shadow on the Indian economy and markets because India is a big net importer of crude. But if we leave aside geopolitics and the external situation, uh, India's domestic macros, we believe, are like in their best possible situation or health over the past 1 or 2 decades, and we'll discuss that. And those sort of domestic macros actually make the environment very conducive for listed companies, businesses to deliver good earnings growth. So both of the points, firstly, starting valuations now are very attractive, and secondly, we believe that earnings already last 2 quarters earnings have been quite buoyant and they will continue to remain buoyant given whatever domestic macros and policies and regulations changes have been done, and we'll cover that in detail. On this slide, Sonal already discussed a slide where he compared the performance of the Indian equities versus global benchmark equities of other countries. And at this point of time, India is clearly the hated market. If you look at any influencer, any advisor, everybody is coming onto Twitter and saying that you should have like invested in Nasdaq, you should have invested in the Korean index, which is up 100%. India does not have any exposure to AI. But I we just want to emphasize that looking at last for just 21, 24 months is not the right period of time. If we zoom out a little and if we look at the performance of Indian equities versus other global benchmark indices over longer periods of time, like if you look at the decade between 2000 to 2010 and then 2010 to 20, then even from 2020 to September 2024, Indian equities have always sort of beaten every other benchmark. Maybe at par with the US index uh, for some of the periods of time, but Indian equities have always performed well. It is just this very narrow period of last 24 months that it has sort of underperformed. And in hindsight, we can try to introspect and come up with numerous number of reasons why it has underperformed. Some may say it is because of zero AI presence, it is because of expensive starting valuation. But honestly, we feel that equities are cyclical in nature and they mean revert. If you look at the period prior to September 2024, the 4 5 year period, Indian equities had done very well. And there was a need of correction because the markets had become sort of frothy. And we feel that it is just a reversion that happened with Indian equities. And now, after this period of underperformance, again there will be a mean reversion, and we feel that the Indian equities will again perform much better vis-a-vis the other global benchmark indices. Uh, and Sonal also discussed this, but this is a continuation of that only. That if we look at again this period of consolidation or correction of last 2 years, Most of the indices started out sort of expensive. Whether if you look at Nifty IT, Nifty FMCG, the starting valuations back in the period of like May to September 2024 were quite high. And what has happened over this phase of correction is that most of the indices have corrected and now are well below their 10-year median period, median period, sorry. So now their valuations are much more attractive, and if we invest at this point of time, their valuations are much more reasonable compared to how frothy they were 2 years back. And another point I want to make is that some of these larger indices, because if you look at something like Nifty IT, FMCG, auto, these are very large indices. Even Nifty Private Bank, these constitute, especially in the large cap and mid cap space, these constitute very significant portion of India's market cap, and these are available at attractive valuations. So there is a large set of opportunity available today at attractive valuation and reasonable earnings growth. And now on this slide, so basically we looked at the median and average correction in companies that have a market cap of greater than 100 crores at this point of time. And we try to bucket these companies by their market cap rank 1 to 100, 1 to 250, which is basically mid cap, then 250 to 500, which is basically small cap, and beyond the top 500 market cap companies, which are basically the micro cap companies. So one point we want to emphasize is that if you look at indices, the indices are not telling the overall story. They are not reflecting the pain that is prevalent in the broader markets. Because if we look at most of the indices, they have only corrected over this like 21-month period by 5%, 10%. But if we look at the average and median correction, that has been quite significant, especially in the small and micro cap segment. Because if we look at the average and median correction in market cap in companies with market cap beyond top 500, it is 46%, which is significant. And for active fund managers like us and who have a strategy of investing in small, micro, mid cap companies, because our investing universe is large and we look at well run companies in niche verticals, niche segments. So there the opportunity set has become very attractive because in individual companies, because of again in small micro cap, what also happens is that whenever there is correction, the liquidity gets sucked out and they face brutal correction, irrespective of how good their businesses are in the short term. So our opportunity set is very attractive at this point of time because uh, uh, beyond the large benchmark indices, the correction in individual names in the small and micro cap space, which is the area of interest for us, has been very significant, and valuations are quite attractive. This is basically a study which we did where we tried to look at whenever there is a correction of more than 5-6% over a period of 21 months. And we just took the large cap Nifty 50 index. What happens to the subsequent returns after this phase of correction consolidation of 21 months? And historically, if you look at both the probability and the median return of the index, 1 year, 3 year, and 5 year periods after such a correction phase, the odds are clearly in our favor. If you look at like 6 or 7 out of 8 times, after such a phase of correction, the large cap index has delivered positive returns, and the median returns 1 year, 3 year, and 5 year periods after such a phase of correction has been very healthy. So even obviously we cannot extrapolate history into the future, that we are well aware of, but we can sort of try to find a pattern or some historical precedent. So history tells us that after such a phase of correction, if we remain patiently invested and the returns or the rewards can be very healthy after such a phase of correction. So yeah. So in the previous section, we mainly looked at like the capital market indices, which sectors have done well or not done well and things like that. Here we want to go into more of the economic factors. What are India's like key economic data are telling us? So overall, before like going into the details, what we want to summarize is that again, if we just ignore the geopolitical situation, I understand geopolitics does have a impact in term on India's economic performance, but and geopolitics have been very bad. But if we just leave that aside, or if you look at every other domestic indicator, they have been very positive. Firstly, if you look at the very basic uh, most important economic indicator, GDP growth has been quite healthy. It has been 7% plus, and if you look at even with this crude price shock which has come about because of this unfortunate and unexpected US-Iran war, even with that, most of the estimations for GDP growth are 6% plus for financial year 27. And again, if you look at CPI inflation, it has consistently come down. We agree that after February, again, it has sort of increased because of the impact of crude price increase. But if you look at like crude prices have again started falling below $80, and and the inflation is still manageable. In fact, one point I want to highlight is that if you look at the May end inflation, India's inflation is actually lower than US inflation. US inflation is still at 4% plus. So, and if we just think back, this is quite unprecedented that India's inflation numbers are lower than the inflation numbers of US. So I don't think like this has happened, at least as far as I remember. And the next important point is that India's banks and corporate balance sheet are in their best ever situation over the last 25 years. If you look at, first of all, the NPA numbers of banks, they are at their decadal low levels. So banks are in their best of health, they are in their peak of health, they are ready to lend out. Uh, Even PSU banks have done very well in terms of reducing their NPAs. They are also in their peak of health. In fact, they are giving strong competition to private banks. So Indian banking system, which is what drives the economic engine, which is what provides debt for corporate capex, working capital, and everything, is in the prime of health. The other point we want to make is that if we again look at the leverage position of Indian corporates, they are also at the decadal low level. In fact, Indian corporates are severely under leveraged. Even uh, we should have actually made that chart as well, but if we compare it with corporate leverage against other economies, Indian corporate is actually very under leveraged. Most of them are carrying cash on their books. They'll be able to fund working capital, capex very easily. And another important point we want to make is that again, because the geopolitical situation has been so tough for the past 1.5 years. First is what it was Russia-Ukraine war, then it was Donald Trump applying more and more tariff on Indian imports, then this US-Iran war. That the market is, at least we feel the market has completely ignored some of the very big policy decisions that the government has taken, or even the kind of rate cuts RBI has undertaken in the past 1.5 years. So in terms of fiscal stimulus, if you look at it, the government has cut income tax, personal income tax rate, individual income tax rate. Now I think maybe, as far as I understand, up to 12 lakh rupees from this assessment year onwards, Indians have to pay zero tax, which is quite a lot of more money in the hand of the taxpayer. And then there was a big in September 2025 end, the GST rates were like rationalized and reduced. A lot of the products came under the 18% GST rate across industries. So that is also a very significant boost to consumption because the prices have come down for the consumers. So this combined with like repo rate being at their lowest levels in the last 4 or 5 years. So even EMIs are cheaper. If you go out to take a home loan today, I think the EMI on the home loan is the lowest ever in more than a decade. So all three are like very positive factors for Indian consumer. So here, one of the sectors which we have specifically taken up to show the impact of the GST rate cuts is auto. Because auto, if you look at it, it's a price sensitive sector. It's a big purchase for an Indian consumer, whether it is a car or and some portions of the auto are also more B2B and commercial in nature. Because if you look at trucks and tractors, it is the livelihood and it is of commercial purpose. So it's an industry that covers both B2C and B2B segment. And if you look at the on this chart, the percentage numbers that are shown that are basically year on year growth in sales of that segment during that month over the same month last year. So once the GST rate cuts were announced and came into effect from 1st of October 2025, you can see that it provided a major fillip to the kind of annual growth rates that all auto segments witnessed, whether it is a B2C segment like two-wheeler or more B2B segment like tractors or commercial vehicles. So clearly the sales numbers picked up after that. Yeah. And moving on to the next slide, as we were mentioning that RBI has cut rates and like RBI repo rate is at 5.25% now. That has also what has happened is that EMIs have become more affordable, and that has also bolstered the credit growth in India. So that is clearly visible. If you look at it, credit growth was quite anemic before September 2025, but now that because banks also take some time in passing on the rate to the final consumer, and RBI is also after the banks to force them to pass on the rate cuts to the final consumer. So that has now started percolating into higher credit growth in the economy, and that also drives consumption and economic growth. Yeah. Finally, even the private final consumption expenditure of the GDP, that is also started showing meaningful growth. And we can also see that in the commentary of FMCG companies in the last 2 quarters. They have finally, after a long phase of like 5, 6 quarters where sales volume growth was very tepid. Now they have started giving commentary that volume growth is picking up for us. We are seeing both rural and urban volume growth pick up. So even it is reflecting in the consumption expenditure. So here we'll just like take you briefly through how our portfolio has performed in and during this phase. Yeah. So this is overall, these charts show the overall health of our portfolio. So like Sonal was mentioning that we have very strict quality metrics for each of our portfolio company. We always look for companies with very healthy balance sheet. We absolutely hate companies with leverage. We are always looking out for companies with healthy cash balances, strong cash flow generation, high ROE. So that is actually reflected in this chart. So if you look at the pie charts on the bottom left corner, apart from lending companies like banks and NBFCs, because for them like they will have to take leverage. Their business model is around taking leverage and giving out loans. But if we exclude like BFSI and NBFC companies, 70% of our portfolio companies have net cash. They are cash positive, and none of our portfolio companies, ex of BFSI and NBFC companies, have a debt to equity ratio more than one. So a very healthy balance sheet. and strong ROE position throughout. If you look at whether it is 3-year average ROE, 5-year average ROE, or the latest financial year, which is FY26, the ROEs, and this is post-tax ROE. I also want to highlight that this is 17.7% post-tax ROE. So very high return ratios. Sales growth has been buoyant across FY26 and historically also. So the kind of bar that we put in terms of the company should have strong balance sheet to be able to withstand any side shocks. The kind of promoters that we invest in, the kind of differentiation our businesses have, those actually reflect during difficult times. Moving on to the next slide, we just wanted to highlight some of the top 4, 5, 5, 6 performing companies in our portfolio, especially during this last 21 months of market correction, consolidation, whatever you call it. And I won't go into details of each name, but we just want to highlight that we buy into companies that are delivering healthy earnings growth. If you look at the EPS growth of these companies during this 21 month period, 21 month is, I think, 7 quarters. The EPS growth has been very healthy. The starting valuations were reasonable. We are not pure value investors that will buy something just because it is cheap, because we put a lot of emphasis on the quality and the business quality as well as the promoter quality, like Sonal mentioned. So our starting valuations were reasonable. These companies delivered decent earnings growth, so they were able to deliver good returns despite this phase of consolidation. Obviously, we have had companies in our portfolio which have not performed well also, but overall, because another thing which we do well is that we increase allocation to our top performers, to our winners. Because of that, overall the portfolio relatively performed well than the broader markets. Yeah. This is the final slide, and we'll stop after that for Q&A. And this we can talk about in more detail in the Q&A as well. So at this point of time, we are focusing on sectors, first of all, which will be able to withstand the supply side shocks that have emanated because of this war, whether it is higher crude prices or like prices of other inputs. So we want to invest in sectors which either have pricing power or like which are doing some niche products or services where they will be able to pass on this price shock that is happening. Second point is, again, we want to invest in sectors which are somewhat like have differentiation over their underlying industries. Like it is not just a run-of-the-mill company that it will have to only rely on the underlying industry growth that it serves. We are always looking for companies and businesses that will have some differentiation through which it will be able to deliver higher earnings growth than the underlying industry. Yeah, and lastly, again, some differentiation, some moat to be able to grow faster than their competitors during tough periods. Because what we have seen is that exceptional businesses actually utilize tough times to even strengthen their business. So we focus on like niche sectors and businesses that will be able to actually increase their market share during this tough phase. And we can talk about individual sectors or companies later on if in the Q&A, but I'll just stop here. So now over to you. Finish.
Thank you, Sonal and Anubhav. Thank you. Thank you for the wonderful presentation. I think there's a good amount of work that's gone behind in creating the deck first and then presenting it, because what we continuously see with people who are very deep into what they do in the work that they do, right? It actually reflects in the way things get presented. So thank you first. And just a couple of questions from FPS Assets before we move on to the Q&A session for the viewers, right? So our question first is on the private and the public thing, right? So you guys are private guys essentially, right? You were with the private markets essentially, and with the due diligence that you bring in from your private market experience also reflects in your public market investing. But then, in terms of navigating the markets, they're very, very different, right? Let's say private markets do not have any sentiment essentially tied to them. They don't have any public perception. So I just want to understand how your view, or rather, how do you navigate a public market versus your private market experience, apart from the fact that both have the same due diligence that you guys put in? So something on that, if you guys can answer.
So Ganesh, just want to highlight and correct that we were part of private equity funds in the past, but there also almost all of our time was spent in investing in public equity, but with the
Right.
framework of the private markets, the private equity framework. Anubhav and I were Anubhav largely 100% of his time. I could say about myself 90% of my time we were spending in investing in public companies only. The same what we're doing things right now, which is small, mid, micro cap investing uh, overall. So that's like the small bit. Second point, if we zoom out and look at markets overall, whether it is, let's say, private equity, venture capital, debt, structured debt, or public equity, everything is cyclical to our understanding. What working in private equity fund gave us was a zoomed out view to cycles across the type that we're talking about. And the learnings, apart from the framework we carry, I think, is also that whenever a particular segment in the market is getting heated up, the answer is not to basically say that let me how do or worry about how do I put money in this particular asset. The the lesson is that we need to step back a little and say, can I not invest in this at the peak of the market? And therefore, one important point, which I think Anubhav also hinted upon, but just highlighting again, is that for us, staying out of the market in peaks, basically, or not investing just for the heck of it in peaks, is something which is core to us. We typically spend in Prescient Capital, typically take 6 to 9 months to take deploy anybody's capital. And if let's say markets are heated, there is no hurry for us to deploy capital or get more names, which is the typical behavior of investors and even newer clients as well. So that's one learning which we carry from the private equity background, which is that A, there is a framework, B, there is a discipline about respecting the cycle, whether it is whichever part of the business the cycle is, whether it's venture, private equity, public equity, everything has cycles basically. Now, and we highlighted that, for example, let's say if large cap is, let's say, a beaten down sector right now, basically, which it looks from the charts that Anubhav is talking about, we should respect that cycle. And I think we should say that this is somewhere which is a large amount of capital can be absorbed as well. So that's that. And I think last point which you talked about, what we carry in journal, I think is the the framework basically, I think makes us question the scarcity of a particular asset, which is what I want to specifically highlight. I think over the last 15 years of public market investing, the first thing I think which we've been taught is to not be overwhelmed by a particular opportunity or an asset or a situation. So, for example, um, uh, Parag Parikh does a great job of explaining why they do international markets, because we think that the Indian investors are fairly myopic in their outlook about India in particular. Um, and therefore, you've seen, let's say, US markets do well, right? Given that India was heated up. Now, it is important to question that why should I, just taking a name, let's say, why should I be buying a Policy Bazaar or Zomato when there are only 15 listed tech companies in India and there are some maybe 500,000 listed tech companies in the US, basically, right? Now, if I am a, if I am a, or let's say if there are four disruptors which are sitting in the private side, against Zomato, let's say, or in quick commerce. The framework that we have, which is the private equity framework, it bakes in us working on saying that no matter whether this company's gotten listed, quick commerce company's gotten listed, it is, let's say, the only listed quick commerce company, but there are five disruptors which are sitting on the private side. So I need to have a very balanced, calculated view on this particular company. I also need to understand what has happened to this sector in China, what has happened to this sector in US, and how the multiples on those markets have actually converged uh,
Hmm.
and gone down over time, and then value this business, and after that say that is it actually worth my time or not.
Understood.
So this is the longer answer to your question. Yeah.
Understood, Sonal. Thank you. Another question on, I would like to pick your brains on this other couple of points that you had mentioned in the presentation, right? You had mentioned that you guys are conservative. You don't like to pay up, let's say, for forward growth that much, right? I mean, you see impending growth coming in, but then you are a little bit conservative when it comes to paying up, right? That, along with another slide where you had also mentioned that this portfolio, it's a very profound statement, right? This portfolio is actually designed to outperform during market underperformance, overall market underperformance, right? So in a way, is your first point of not paying up or not buying into too expensive names, or rather being very, very strict with valuations, contributing to that factor?
So, Ganesh, I'll say that it's not only about valuations. Like I mentioned that obviously we are very conscious of valuations. We don't want to pay up, and we pay up very heavily for future growth. But
Right.
on the other hand, what we have also seen is that pure value also does not work in India. We won't
Right.
buy something just because it is cheap, no matter how
It's
well
cheap.
the
Got
balance sheet is and all things
it.
like
Got it.
that. We are
Got
very valuation conscious, so we also don't want to pay up like abnormal valuations, like 100 times. You would have seen some of
it.
the I don't want to take
Absolutely.
individual names, but some of the very hot sectors, maybe some data center ancillary, where like
And yeah,
abnormal amount of growth is being baked in the expected valuation. So we don't want to do that also. So our sweet spot is growth at reasonable valuations, and obviously, like you mentioned, paying reasonable valuation helps during times of downturn because of the more expensive the asset is, the more expectation is attached with it. So if your starting valuations are reasonable, even if a thesis, if the company underperforms our initial thesis by certain margin, it doesn't get beaten down by that. So
right.
reasonable valuations help, no doubt in that. But I just want to add another color or layer to that. What also helps is that we are very binary on the asset quality. And it may seem very trivial. You would feel that what is he saying that but actually we are very stringent about that. That we focus a lot on whether like this business model historically has it generated enough cash flow or not. So lot of and nothing against or but what we feel is that lot of the public market investors are very P&L driven. That how will the P&L
Right.
look in the next financial year? What will be the margin? And we really admire them that they do a lot of work on even things like rubber ka price itna बढ़ जाएगा, so how will it impact the EBITDA margin by half a basis point? We are not that focused on
Yes.
just like how will the P&L look in the next quarter or like we are firstly patient investors. On the other hand, we are very stringent about the balance sheet, cash flow, the strength of the business. Like you are mentioning, we always end up buying companies with net cash balance sheet, and things like that
Absolutely.
really do help in times of uncertainty on in challenging periods where we always like companies where the promoter, and these are softer aspects, not everything can be put in numbers. We always try to buy companies where the promoter will give up some business just to protect his balance sheet. Like if he feels
Right.
that export order will have a very long receivable cycle for him, he will give up. We have examples of such companies where the promoter will give up the P&L for the balance sheet. So
Right.
that is another aspect where we are very stringent on how the basic fundamentals of the business are, how the basic cash generation is, how is the ROE, the leverage position. So that also helps a lot during times of downturn. So it's not, I would say, just pure valuation. Yeah.
Got it, Anubhav. I mean, that's a profound statement, right? You're looking for people who would accept short-term pain, or rather, who are okay with giving up, let's say, a temporary P&L strain
Opportunity.
for
Yeah.
strengthening. Absolutely, absolutely, got it. Now, a question on the investor's psyche as such, right? In terms of, let's say, for the last 20 months of the markets, which have been pretty much tiring for a lot of investors because they might have initially paid up, or they might have not participated at all, or they might have been participating in a theme which has not grown in terms of price, at least not in terms of, let's say, fundamentals. So with that, how do you think an investor can keep their nerves all right? I mean, it's a very subjective question, but then I would like to know your views on how your investors are keeping their psyche also, right? In a way of because most investors that have an expectation, they know they're going to make returns if they don't make returns for 20 months, right? But then it's like they try to make money out of every cycle. So the expectation of trying to make money out of every cycle is somewhat entrenched in their mindset. Do you think that's a fair expectation, or is it reasonable at all, or do you want to set the expectations right in a way, something on
Yeah.
that?
So, Ganesh, maybe I'll like go at it first, and then Sonal can add to his
Sure,
viewpoint.
sure.
So I think that's not a fair expectation
Okay,
because equity by nature is volatile. It does
right,
not give return in a linear fashion, and
right,
that is the slightly unfortunate part. That is true for
right,
several other asset classes as well. We talk about gold, we talk about real estate, but if you look at
right,
any other asset class, there has been very long periods of time where real estate in different micro markets. Obviously, real estate has its own micro market. North India might be different from South India and things like that. But in every micro market, everyone knows there have been phases of 5 years when real estate prices have gone nowhere. And even in gold, gold is a very liquid asset, and everybody knows there have been like periods in the past where gold has been flat for even 10 years. So every asset goes through its phase. I think what is slightly unfair in the way, and this will improve over time, and it is our job as fund managers or guardians of our investors' wealth that we keep on educating our client, communicate consistently. But just to come back, I think it's slightly unfair for quite a lot of equity investors to expect that every year I'll have a 12, 13,
correct,
14% kind of. It can't be that. Equity by nature is volatile, and
correct.
that volatility has to be uh, like that pain has to be felt by the investors, because in long term we have absolute like conviction that equity is a beautiful instrument. In fact, it is the most beautiful long-term instrument, because if you are invested in the right kind of businesses, you will face volatility, because in the short term, like emotions outweigh the fundamentals. But in the longer term, there is no way if you are invested in the right businesses, you won't end up making money. But that volatility or that pain to some degree has to be experienced by all participants in equity market. But as fund manager and as like somebody who at least we believe we are sort of guardians of our clients' wealth. What is our job is to first of all be very honest in our in setting the return expectation for the client, be very honest in communicating, and that I think we do, and we want to again say it on this forum as well, that every client who joins us, we tell them that don't invest with us if you have a short-term view of less than 2 years, because in 2 years we can't. In fact, especially our kind of strategy is very designed and for the longer term. In fact, we buy underappreciated assets, though those may continue to underperform in the next 6 months. So I think we should be very consistent and open in our communication that uh, you should only invest if you have a horizon of at least 3 to 5 years, and you should judge us during that time period, and we should be also very open in telling our clients that during 6 months or even 1 year, they can face a correction of 15%, which is very normal in equities, which is not abnormal. It's by design. So
Correct.
I think our job is to be consistent and honest in our communication, and I think that is something at Prescient we pride ourselves on, that we are always very consistent and honest in our communication and very regular also. That each month, I hope you know that we send out a
Yes.
monthly update where also we keep on telling our clients that even during this slightly longish phase of 2 years, we have been consistently telling them that don't lose faith. Equity is a game of patience and conviction. We have been very consistent in saying that, and maybe this another next 6 months can be even tougher. But another thing we have done well, I think, in our communication, and we have been prompt in that, is that during when the markets have corrected quite significantly in a very small period of time, like this March and last March, which was March 2025 also, when like in a span of 1.5 months, market went down by 15% plus. We were very vocal in saying that take advantage of this correction, because as
Yes.
small active fund manager, that is our also job. Our job is not only about stock selection,
Correct.
also telling the client that during phase of correction, you actually have your IRRs will be much better if you invest during such phases. Don't panic. Like remain convinced, and in fact take advantage of this correction. And we are very vocal in saying that.
Absolutely. I can attest to that as well,
And
because the kind of communication that we get as asset allocators from our end, right, from our manufacturers, the PMS manufacturers of mutual fund, that helps us a lot in communicating what the manufacturer actually tries to say. In that way, I think Prescient has done a great job in communicating that I would want to attest to before. I mean, sorry, Sonal, I think you can. Oh, I just wanted to
no, no,
bring
no.
that
I,
up.
I, I was I was just adding a point when you were speaking, and is that I think it's also fair for clients to have unreasonable expectations or have emotions, right? We
Right.
think it is a 24-month journey, roughly
Right.
give or take, whatever, for any client to throw the emotions out of the window. We
Right.
would be helpful in that with our communication, with our webinars, with our memos, with everything. But typically, it takes that much time. We've had a 5-year journey at Prescient where our clients have seen, I think, some 3 to 4 corrections now. We've held our communication high. We've held our one-on-one interactions and cases fairly high. Our webinars fairly high. As Anubhav was saying, specific discussions around topping up at the best times pretty high. And that's our job. Uh, we think people typically take 24 to 36 months to uh, find that
Warm up.
emotional equilibrium, and then the real investing starts.
Absolutely. Got it. Thank you, Sonal. I think I'll stop here with our questions. I think we can get on to the Q&A session. For people who want to put in their questions, please go into the chat box and type in your questions, and we'll be happy to answer them. Any questions from the viewers, you can click on the chat button on the chat window and put your questions there, or you can raise your hands as well. And
Yeah, you can raise your hand. We'll be happy to answer your questions. Thank you.
okay, I think we have our first question from Ms. Harshita. How much risk am I taking when I compare it to a normal PMS or a mutual fund? Okay, it's a very, yeah, please, guys, yes.
Uh, so, thanks for the question, Harshita. See, PMS and mutual funds or AIF essentially same asset classes. I think the regulator may have classified them as different names. What essentially you are uh, looking for is a good fund manager, a trustworthy system behind them, so that the system gives you enough information of how your returns are faring. There is a fair bit of communication, and whether it is a PMS or an AIF or let's say a mutual fund, the regulator, which is SEBI for India, has put enough guardrails, bells and whistles around the system that we are fairly well governed in terms of, or a very well-oiled machinery in terms of uh, the license that we've got as a mutual fund or a PMS or a AIF. So in our mind, let's say a mutual fund, obviously it would be a many fold of us, but for a customer, I think it is important to evaluate a PMS or a mutual fund or a AIF in a very simple three things. What has been the 5 year, 10 year, or let's say 3, 5, 10 year return for this particular institution? Is this institution trustworthy, reliable? Basically, second. Third, does the in case of PMS, there is a higher order of approachability of clients with fund managers. So communication as a key parameter here, where you can say that, do I have access to information? Do I understand what they're doing? Do I have enough information with me, my live portfolio in front of me, to gain more confidence between the two? Or uh, choosing between these. And lastly, the liquidity event that most important sorry, forgot to mention that if you are investing in a mutual fund or a PMS or AIF, fundamentally you should ask that if I need my money tomorrow or day after, am I able to withdraw my money from the system the way the system is structured? If the answer to these is what you compare, you would find that typically uh, most of the PMSs and mutual funds fare in a similar manner. So from a risk of the entity, from a trust of the entity, communication of the entity, and the liquidity back to the customer, if it is comparable, there is no differentiation somebody should have between one versus the other. Obviously, in a PMS, you need to put 50 lakhs upfront, so it's a far deeper commitment, but nothing otherwise.
Got it. Thanks, Sonal. There's another question from Mr. Manoj. He's asked if how much percent approximately inside my portfolio do I allocate for the private equity asset class, which can be a reasonable as a moderate risk investor. So I think the question is more like, let's say it's a private equity type of a product. How much of my portfolio should be, if I'm a moderate risk taking investor, how much should I allocate? So something on
So,
that.
so I think overall we are still a public market product. The style, obviously, we were trying to frame our style of how we go about investing even in public equities, and that is why we explained how it is similar to a private equity approach of in terms of that we are also very long-term focused in our investment horizon and do a lot of diligence on the promoters, which is something which we have picked up from our private equity experience. But essentially, our product is also a public market product. It is a small micro mid cap focused strategy. So overall, I think uh, like how much you should invest in a product like us, sort of maybe you need to work with a financial planner around overall how your asset allocation should look like in terms of how much you should allocate to equities. And then within equities, maybe do you want something which is low volatility, low return, or higher volatility, higher return. Uh, and in terms of your risk taking, then it has to be defined that how much do you want to allocate to a product like us. But in terms of, because the previous question was also about risk, so actually we believe our product is very low risk because we define risk in terms of actual product, like actual loss of capital or negative returns or things like that. So, like we also dealt with in the presentation, that we have several checks and balances to reduce risk. In fact, by reducing risk is how we improve our return, is what we believe. And there we discuss things like not overpaying, doing a lot of diligence on the promoter, because the number one reason why retail investors lose money in equity market is because they invest in poorly run corporate governance mismanaged companies, So again, that we do a lot of diligence on the promoters to reduce risk. We don't overpay. Third is we are not very short-term focused. That if there is a correction, we panic and sell. We understand that what we need to focus is on the business and have a longer orientation rather than keep on focusing on the share price. So things like that. But yeah, volatility is different from this. So if you think about volatility, obviously our product has volatility. It is a small micro mid cap strategy. So it is relatively higher volatility than a large cap mutual fund or large cap PMS. So definitely because we invest in small micro mid cap, there will be periods of volatility, and that you should obviously be something which is you are comfortable with, and you should obviously that is something which is very individual and personal. But how I would categorize my product, our product is Prescient is that we have slightly high volatility, high returns, but essentially, again, I want to reiterate is that volatility is not the same as risk. In fact, volatility is opportunity also, because when prices correct and the business, like I was mentioning, that it is actually a good time to take advantage because the same businesses, well-run businesses are available at cheaper valuations. So for us, volatility is actually an opportunity also to average down and invest more in high quality businesses. So definitely we are medium to high volatility, but risk is something else. Like I mentioned, risk is loss of capital or negative returns, which we try to minimize through our framework, uh, like I explained. Yeah.
Thanks, Anubhav.
Ganesh
I
next.
think, yeah, I hope that answered the question, Mr. Manoj. And there's another question. FIIs, thank you, Mr. Arvind. Thank you for the comment. And FIIs are looking at markets outside India primarily for AI. What are your views on AI? Do you see it as a bubble? When can FIIs return to India? Okay, I think it's pretty
That's a
silly
million
question.
dollar question.
Yeah.
So, so maybe I'll share my views and Sonal and Ganesh can add to that. Honestly, we have very limited understanding of AI. We won't even like try to say that we are AI experts. We are not. Like obviously, we are not technologists that we are deep in creating AI and working on AI models, and we can talk a lot about how pervasive AI can be. That remains to be seen. We can only look at it from the lens of an investor. So the very first point we want to make is that AI is very real and it will become a part of our life just like any other tech innovation in the past, whether it is internet or smartphones or whatever. There have been many technology or cloud migration and things like that. So AI will is a very real technology. It will become a part of our lives. I think we can all agree to that. The second point is how do we look at it from a point of view of as an investor. So obviously there is an AI wave that is very much there, and unfortunately India does not have a very direct AI play. That we don't have our own models or we don't have semiconductor companies making graphic chips for the AI industry or something like that. And that is unfortunate, but it is what it is. And obviously the initial AI wave, any good investor that was able to catch that has done a remarkable job. But today, if you look at it, it's simply like a momentum in any other rising industry. Like we talk about data center, and there are data center proxies in India as well, because we have a lot of power equipments, and there is a company called TD Power which supplies gensets to the data center industry. There are other companies as well. So even in India, there are proxies. But if you look at the wave of AI from an investing point of view, it is very clear that it's not in its initial phase because a lot of returns have come. Because if you look at just even Korean index, it's up by some 200% in the last 1 year. So right now we are somewhere in the middle of this AI investor bubble. So that I think we can very categorically say is that at this point of time, anybody who is entering this AI wave just without the underlying having very strong underlying understanding of the industry of semiconductors and things like that, He's just taking a momentum call. And that happens even in Indian markets as well. There are some very hot sectors and which give good returns, and people chase momentum and enter at somewhere in the middle of the bull cycle. That momentum seeking behavior is wrong. So at least we feel that right now, if somebody is just going and saying that I want to invest in Kospi or I want to invest in Nvidia because it has given good returns, I don't think he's taking a very informed bottoms up call. He's just chasing momentum. Let's agree to that. And the third point is that if you look at every technology wave, obviously the technology persists. Internet has persisted and become very prevalent in life. But because so much bubble was created and so much initial returns were made in that way, that the initial wave captures a lot of the future earnings. I think AI is also at that stage where a lot of the returns have been made, and that has already captured a lot of the future potential of that industry. So I'll want to summarize by saying that we don't know when this AI bubble will burst or how long can it persist. But somebody entering AI companies at this point of time without having very fundamental understanding of the industry, it is a very momentum seeking. Like I was saying, every fin influencer, everyone is saying that you need to invest in Taiwan or Indian market is dead and things like that. India is dead for the next 30 years. I think that is what they're saying the same thing since in May 2024. I can bet that you won't find like uh, even few instances of the same people saying that back to 2 years back that you should exit Indian markets because at that time Indian market was doing well. They were making videos of how to invest in Indian market. So right now in the middle of this bubble, if people are saying that go and invest in it, I think it's momentum seeking. First point is that. So we can't say when the AI bubble will burst, but the second point is a very important point is key overall what happened, and this happens again in Indian markets as well. In Indian equity also because the behavior of investor is very hard like everywhere, whether it is US, India, where क्या होता है people feel that whenever exorbitant returns are made in some portion of the market, they tend to overlook everything else. Even in India, it's happening. There are and that is why we find good companies growing at decent pace, available at cheap valuation. Because right, even in Indian market right now, what is happening is that this is a data center proxy, or this is like supplying to some data center opportunity, and the stocks have run up to like 100, 200 P. Even in Indian market, there are companies like that, and the rest of the market is being ignored completely. In fact, Indian market is just like that in the global scenario because the AI wave is happening. Overall, globally, investors are only looking at the AI wave. Where can I invest? Where can I make 100% return in 1 year? India is the non-AI market. I won't even look at it. But that does not mean India is not growing. Indian companies are not growing. There are very good manufacturing companies. The world needs manufacturing. The world needs agrochemical. The world needs chemicals. It's not like we eat, breathe, and everything will be AI. There is a lot of opportunities, and in Indian market, India is actually a much more, again, one important point is India is much more broad-based market compared to Taiwan or Korea or Japan, where it is like two companies are 40% of the index or things like that. Here we have like banks, healthcare, pharma, so many diversified industries in the top 500 market cap. So what is happening with India is that we can absolutely say that India is being ignored. Nobody's it's the same kind of herd mentality जो Indian investors maybe we see that is happening with the global investors. That India is not AI, will not look at it. No matter there is some steady growth. Obviously, it will be lower than the AI growth, but there is growth and available at cheap valuation. So India is again that neglected part of the market. And we don't know when FIIs will return, but everything mean reverts. I think the single biggest universal truth of equities is that there is mean reversion. Neglected sectors uh, of the previous bull market, uh, uh, become the biggest wealth creators in the next bull market. Mm, if you look at even bulls markets in India, no sector has remained the top performer in each bull market. In like between 2010 and 20, there were investors who were saying that buy Asian Paints at any price, buy HDFC at any price. These were the largest wealth creators. FMCG was the largest as a sector, one of the largest wealth creators in 2010 and 20. And capital goods, engineering, infra was like dead down in the dumps between 2010 and 20. And after 2020, when the capex cycle started in India, you see at the performance of any cap good, any engineering company, there have been 100x like companies. You look at CG Consumer, where it was a sick company back in 2020. And today it's greater, I think its market cap is greater than maybe like some of the FMCG companies. 1 lakh crore plus market cap. So again, like you have to look at underperforming neglected sectors to find the winners of the upcoming bull market.
I think in all times context matters, right? I mean, because investing is an extremely contextual exercise. So, yeah. Thanks, Anubhav. I think there's another question from Harshita. So I've already invested in a small cap mutual fund. Does your product complement my investment?
Sonal, do
So,
you,
so difficult to say from an outside in perspective, ma'am. Maybe there is an overlap, maybe there is none. Uh, our median market cap of our portfolio is somewhere around 7,000 to 8,000 odd crore of market cap, which is on the lower end of the small cap list of companies. I think the small cap companies uh, start with $1 billion market cap, which in today's days is around 9.5 thousand, 10,000 odd crores. Uh, so maybe there is an overlap with some, but from an outside in perspective, it may not uh, be overlapping with your mutual fund. The other thing I want to highlight is we manage a portfolio of give or take 20 to 25 odd companies. The mutual fund has typically roughly 50 plus companies in their portfolio. So even if maybe we have, let's say, out of the 25, maybe we have 5, 7 names uh, which are overlapping, theoretically speaking. Uh, the allocations may be significantly different from a mutual fund. And I think that is where the point I was making earlier that so people talk a lot about multi-baggers, a lot of podcasts get made on multi-baggers, and everybody wants to harp about those multi-baggers. But if you've not done allocation to those multi-baggers in any meaningful manner, then it is as good as a mediocre uh, asset allocation and a mediocre return. So something which is given 100% return but is 1% of the portfolio is nothing. But something which is given, let's say, even 50% return and is 10% of the portfolio is meaningful delta to the portfolio. What people like us basically get to the table is the latter, where in a fewer names, because of the deeper research, because of the deeper conviction, and having looked at companies for 3 to 5 years before investing in that particular company, our convictions are far higher. Because of which we don't shy away from putting 7, 10, 12% of the 100 rupee pie of a particular customer behind a name. And I think if, let's say, if we do this for, let's say, even 5, 6 companies, um, even two or one of them basically delivers a stellar return, our returns would be meaningfully higher than, let's say, the small cap or large cap or mid cap fund manager on the mutual fund side, because typically their allocations is like 1%, 2%, 3%, at best 4% of the AUM in a particular name. So names may be common, may not be common, but allocations is what basically decides the returns of any PMS, AIF, and a mutual fund.
Got it. Thank you, Sonal. Anubhav, you had something to say? Sorry.
No,
No,
I
nothing,
think
nothing
No, no.
specific.
Okay, got it. I think we have another question from Mr. Hari. With a highly volatile and high return product like yours, how long should an investor stay invested to get the best returns? Again, best. Okay, I'll let you guys take the question.
So,
so.
yeah, Sonal, please go, sir.
So I have a quick answer to this, and I think we can explain that typically there are no lock-ins in our PMS. You can like decide to move out whenever. Essentially, it's just want to keep that out of the window. But typically for us and equity investing in general, as Anubhav was also saying, um, I think it is important to stay put for at least 2 to 3 years in any equity product, whether it's a mutual fund or a PMS or an AIF, to make meaningful returns. Um, and because I think in the short term, as Anubhav said, volatility can take over. So we also have, I think, clients because uh, we've given 10% return in, let's say, a 12-month period over a 24-month period. Now, from any stretch of imagination, this may not be stellar returns, but there are decent returns in relative parlance compared to indices. Now, clients who've basically stayed with us for 2 years, they may say, "Oh, you've delivered 10% returns, which are not great." But the same vintage basically may change significantly if the client who stayed with us for 2 years experiences as we speak. As Anubhav said, this is a great time to put money. If he stays put for let's say 1 year, 2 year from here on, his IRR can actually beat and go up to 18% to 22%, which is the longer term average. So that's what we talk about, I think, statistically, that typically if you're come with an outlook of at least 3 years, basically, for any equity product, and in particular about us. Secondly, about our product, since we're looking at companies which are typically low on the radar of mutual funds, they have lower institutional ownership, are little smaller in size. Um, their discovery sometimes takes 2 to 3 years as well. So now I'm talking bottoms up. First, I answered you from a top-down perspective. Typically, the discovery of these companies takes 2 to 3 years. When I say discovery, the institutional ownership coming or FIIs finding companies interesting is something which takes 2 to 3 years. And we've seen that most of our returns for such companies which are doing well and that get discovered are back-ended. So again, that also proves the point that staying put for 2 to 3 years is something which is typical, a good uh, way to enjoy your returns because some of these companies have returns which are back-ended as well.
Got it. Thanks, Sonal. Thanks, Anubhav. I think good number of, good amount of time has gone into answering questions. Is there any other question from the viewers? So if there are no further questions, then we can conclude the meeting right now. And just some concluding remarks for our viewers as well, right? So from FPS assets, it actually wasn't a very easy task for us to, partner up with the Prescient because it was more of they're very, very specific on who people they partner with because the product as such that they're building from the ground, from there and right it goes in a lot of due diligence goes into it and a lot of effort goes into creating a product like Prescient's PMS where I would want to openly state that the kind of work that you guys do on in terms of research or in terms of the deep dive that you guys do in terms of portfolio curation is immensely beneficial for a lot of our clients. So and just from our side what we are also trying to do is we are creating a lot of infrastructure, if you will, right, with the recent PMS Chronicle that we had released from our end, from our research team, right? So, I would love to hear you guys talk about it as well in terms of feedback and whatever, how it can help both the, let's say, our partners and the clients alike. And just a couple of words before we close for the day, Anubhav and Sonal.
Ganesh, first of all, very, like, really thankful for your kind words. Obviously, we would also like our partners to bring in the same kind of rigor that we also aim for. Whether how much we achieve is obviously uh, like remains to be seen. But I really appreciate uh, in terms of your rigor in understanding our strategy and our
Thank
product.
you.
And obviously, on the previous chronicle, it's something you shared, and we have gone through that and very researched and very insightful for all end clients as well. So we'll do our bit in sharing that.
Because the due diligence that we went as a team, right? Where we went through as a team before we found you guys and then spoke to you, and then we had an interview, if I remember, with Sonal for an hour, where it was more like, okay, I need to choose you guys. So what are you guys bringing in types? So I mean, I know the kind of work that you guys put in, because the kind of respect that you show for the work that you do is immense. So we know how it is to work with you guys, and thanks a lot for spending a lot of time in today's webinar. And Sonal, any words from you?
Now, I just want to add to this. I think since I think we've started partnering with each other, and the discussion we had, I think we also learned that teaming up with fewer partners who are deeply entrenched in the success of their clients, handling the emotions of the clients in times like what we've seen in the last 24 months is extremely helpful for not only us but also for the longer term equity journey of the client by and large is something which we've seen is a real differentiator of somebody who's a distributor. I think when we partnered with you guys, the 1 hour discussion we had, I think one part was us discussing about you guys, but the other part was also how much value would you add in times like these? Because this is something which is, I think, the cornerstone of any relationship. Uh, because I think the clients know you, they trust you, your clients specifically, they trust you far more than they trust us. We are a manufacturer, but I think the what I talked about, the 24 months to 36 months of baptization into the equity markets, a lot of effort on that side relies with you guys than actually with us, to be honest. And I think what I heard from my references, you guys do a great job of that. So yeah, let's, I think, continuing the deeper research that is good for both. Yeah.
Thank you. Thanks a lot, Sonal. That really means a lot to us. And thanks to all our viewers for, I mean, giving away your Saturday morning, right? And it's a long weekend. I hope you guys have a great time during the weekend. Thanks once again. Please get in touch with us if at all you need any queries to be answered. If you have any other queries, you can just reach out to us, and then we'll be able to help you uh, get your queries answered, right? Thanks all. Thanks all. Thanks all.
Thanks,
Thank you.
everyone. Thanks, Ganesh. Thanks, the FPSC.
Thank you.
Thank you.
Thank you, Anubhav. Thank you, Sonal.
Bye.
Thank you.